Hello everyone, this is Ahura and we'll be with you with the Federal Reserve meeting review, decisions and market reactions. As you know, the market was waiting for the Fed announcement after its today's meeting on June 17 and 18. A few hours ago, the meeting is finished. Now it's over. We have already the statement, press conference, and market reactions at the first hours. Today, markets on Thursday, market is closed in the United States, so but the futures market is open. Anyway, let's go further and check what we had. Fed held the interest rate steady at 4.25% and 4.50%. That was widely expected. And the committee say that they are still committed to achieve the maximum employment and inflation at the rate of 2% over the long run. That was no surprise. That's what they are always repeating in the statements. In the statement, they mentioned that the both risks are equal. Both labor market and inflation have the equal risk. So I mean, there is nothing specific and especially changes in the statement. But the thing was, as mentioned before in the weekly outlook, also the focus was not on the statement. The focus was on the dot plots where the Federal Reserve members have their projections. In the press conference, also, Mr. Powell mentioned that the labor market is fine, economy is growing fine. They mentioned that the 135 or 39,000 average the newly created job or NFP numbers, newly created job in NFP reports shows that the labor market is growing fine. The U.S. economy is holding the current condition, is holding the fine, good condition, and it can actually process the higher rates. I mean, there is nothing special in the U.S. economy. I mean, there's nothing worry about U.S. economy, and they are in a condition that they can handle the higher rates for a little bit longer till they wait and see what can happen as a result of the tariffs. As you know, the tariffs reaction actually is not started yet in the reality in the market because we had a pause in the tariffs after they started, but they had a 90 days pause. So the real tariffs reaction, the real tariff effect going to start from the next week when the 90 days pause will be over and the countries that they didn't reach the decision, they didn't reach the agreement with the US, they're gonna accept this 10%, at least the minimum 10% tariffs and more for some other countries. So let's go and see what happened in the Dutch plots where the market focus was. When we are looking at the dot plots, there are several things that should be closely watched. One, the Fed projection of interest rates, the Fed projection of inflation, and the Fed projection of labor market or unemployment rate. Still, the GDP projection also is very important. So let's go and see what happened one by one. As for GDP, in a March meeting, the Fed or FOMC members, they were expecting to see the GDP to grow by 1.7% in 2025, which is lowered right now at 1.4%. Unemployment rate, they were expecting to see the 4.4% for 20 by end year in 2025, but now the unemployment rate is reached to 4.5%. As for inflation, PCE price index was expecting at 2.7% in the March meeting. Now we can see that at 3%, while the core PCE price index, which was expected to be seen at 2.8%, now is projected at 3.1%. However, the Fed members still expecting at least two rate cuts for now for 2025. So still 3.9% is where they can see the targets. I mean, the inflation, the rate targets by Fed interest rate targets by year end. As for 2026, also they lowered the GDP growth. They increased the unemployment rate expectations from 4.3% to 4.5%. Same, they increased also the PC price index and core PC price index both to 2.4% from 2.1%. For 2027 and long run, they didn't change much. Yeah, there's a little bit still change, but they didn't change much for the interest rate and GDP growth. But still, generally what we can see here in the short term in 2025 and 2026, or in the midterm, we can say the central bank is expecting to see the lower GDP growth, higher inflation, and higher unemployment rate. All these numbers telling us that the Fed should be still, the Fed members, they are more cautious about what they are deciding, because at the same time, while they are expecting to see the higher inflation, that at the same time they see lower economic growth, which means that the Fed should bring down, should lower the interest rate to support the economy. At the same time, they should hold the interest rate steady to control the inflation. So they are still in a crossroad, which makes the decision much more harder to make the decision for Fed members. Still, anyway, what we can see here as a data that, and what they mentioned also, what Mr. Powell also mentioned in the statement and the press conference, they have to wait and see what's happening in the market, especially after tariffs affecting the markets, affecting the prices. So for now, Fed is still changing. So Fed, we can say in a more detail, if we go to more detail, we can say that the Fed didn't change its interest rate expectations, outlooks at 3.9%, and its cautious tone in making a decision. So both they are same as we had it before and we were expecting. So the market for now, I'd say they got a little bit more confidence on holding their rates for longer, at least till September. If you go to the CME Group FedWatch tools, also you can see that as you can see here in the CME Group FedWatch tools, for September now we have more than 60% chance of interest rates cut by 25 basis points or 25%, 0.25%. But for July meeting, there is still more than 89%, almost 90% chance of holding the current rate. So the Fed, so the market now still counting the first rate cut on September meeting, no rate cut before that. That's what happened in the meeting. Now let's go and check the charts and see how the market reacted to these charts. As we can see in the charts, US dollar index getting encouraged after this decision. That was very expected. In the weekly outlook also, I told you, mentioned that now the dollar is getting trying to recover some of its loss that it had in the previous weeks. So for now, with the expecting of holding the hard current rates for a little bit longer, at least in September, that can support the dollar index to recover a little bit and get above 99. For 90, between the 99 and 101 is the where we expect to see the dollar index, or we can say at least above the 99. Higher or above the 101 mark also is very less likely, as the trade tensions are still ongoing, still continuing, and we have too many other risks for the US economy, which will hold back the dollar index to gain more against more other currencies. So for now, what we can say is that the dollar could have the side movement between 99 and 101, as the higher for longer is the most likely scenario, at least till September. For this higher for longer should be negative for stock markets, as we can see in the reaction. S&P 500 is back under 6,000. Nasdaq is getting under 22,000, moving towards 21,000. The next target is 21,400, and then under that 21,000 by itself, and then breaching under the 20,000. Now I am actually negative about the stock market's downtrend. So the downtrend is more likely to see. As for Dow Jones, you can see for Dow Jones also is the negative. If we push under 42,000, the next target at 38,000 can be very likely to be seen. So that's what we can see in the charts and the market reaction. So the negative, you're negative for all markets, no matter for stocks, crypto, for Dow Jones, Nasdaq, and S&P 500. As for cryptocurrency markets, also same as the risky market, or the negative for the cryptocurrency also could be slightly negative, but it cannot be read as a negative news. Let's go check the current commodity markets. As the dollar index getting stronger, we can see the demand for the dollar index at the same time. Higher for longer means higher rates. And when we see the higher rates, when the bond rates also, when we can see the yield is higher, we can see the less demand for the gold. And profit taking over all this condition, they make they're lowering the risk in the geopolitical tensions and ongoing in the Middle East. All they lower the gold demand for now 3,200 and 3,300 is the next target for under 2,200, but above 2,250 somehow somewhere around this will be the next target for gold. About the oil and energy market generally, condition and geopolitical condition in the Middle East can increase the demand for the can increase the demand for energy for oil, but still totally what we can see here is I mean what we can see here in the market is that what if you check the market reports, the weekly reports, we had 11,000 draw in the weekly energy report in US inventory reports, which is the positive for the oil and energy market generally for the price. But totally with the ongoing condition in the market, with the supply and demand, the number of the supply and demand we have in the market, between 72 and $76 is the expected range for the oil, but we don't have too much encouragement about $76 as the expecting the GDP expectations for the most economies getting lower. When we have the less GDP, we can see the less demand for energy as well. Yeah, this is what's happening in the market and market reactions, decisions, and reactions. If you had any other question, don't forget to write down in the comment section. I will try to get back to you as soon as I can. Have a good time. Bye.